So many people are like, but the CPI, but this or that. Doesn't matter. Who gives a crap about the numbers? It's all about the reaction to the market. That's what's going to tell you what's going to happen, all right? That's what's telling you where the market is. And by the way, this doesn't mean the Fed is going to start dropping rates just because the dollar's coming down a minuscule amount. My guess is it's telling us that rates are here for longer, meaning they're going to stay up for longer, but the Fed is likely potentially done because economic news is going to be so horrendous in the next 6 months that they literally won't be able to raise anymore. And that's, again, why you're seeing it stall out here versus with the CPI being hotter, it would anticipate a higher move in the dollar, and you're not getting it.
The dollar index strengthened on Wednesday as U.S. economic data revealed a rise in August's inflation, albeit with minimal impact on Federal Reserve interest rate hike expectations. The consumer price index increased by 0.6% last month, the most significant gain since June 2022, driven primarily by surging gasoline prices. However, when excluding the volatile food and energy components, the CPI only moderately rose by 0.3%, partly due to declining prices for used cars and trucks. Market consensus remained firm, expecting the Federal Reserve to maintain its current interest rates following the upcoming policy announcement, with a 97% probability according to CME Fed Tool. Despite some initial optimism following comments from Bank of Japan Governor Kazu hinting at a potential shift away from a negative interest rate policy, hopes waned as influential ruling party lawmaker Hiro Esio expressed a preference for an ultra-loose monetary policy on Tuesday. This led to fluctuations in the yen's value at the beginning of the week. Gareth Soloway, in his video analysis, pointed out that the inflation data largely aligned with his prior expectations, indicating stability in the overall economic outlook.
Take a look at what we got here. Now, I've basically put the numbers out here. Notice the reds. The reds mean it was hotter than expected for those numbers. So very easy to tell here. Essentially what we have is we had core CPI month over month, right? That was expected to be 0.2%. It came in hotter at 0.3%. All right, so a little bit of a miss there, a little hotter inflation on core. Now, we know gasoline, we know energy prices in general have been moving up, so maybe that's starting to take an impact. Now, core CPI year over year, which again is in the last 12 months, what was the number to this 12-month period? It was expected to be 4.3%. It came in at 4.3%. Okay, so equal. That was a non-event. That's what we expected. CPI month over month forecast, all right? So now we're talking about month over month. So this was month over month core, year over year core. All right, month over month regular CPI came in at equal 0.6 to 0.6. So nothing to write home about there. The last one, year over year regular CPI, and this is a big one, folks. Forecast was 3.2, and the CPI came in at 3.7. So this number here and this number here, hotter, these two were equal, right? So what does that mean? It means overall inflation is hotter than expected in these numbers. Now, initially, the dollar soared, yield soared, again, 10-year. Essentially, the market's thinking the Fed might have to rate hike again. Probably not next week. Obviously, markets are not pricing that in. But what about November or December? Are they going to hike more there? Interestingly enough, what I do is I say, okay, this is the numbers. We know that they came in hotter than expected. It would imply the markets might sell off. It would imply the dollar may go up more. It would also imply yields could go up more. But you know what you do? And this is the key, guys, because don't rely on numbers based on consensus estimates and if they beat or miss. That's an indicator. What you need to do, you need to jump into the charts themselves and take a look. So that's exactly what we're going to do here, guys. And look at this. This is the US dollar. All right, so the first thing I do after big numbers come out, I say, okay, what is the US dollar doing? And what we could see here is initially it spiked up, right? That was the initial reaction. That's like, holy cow, these numbers are hotter than expected. But then look at what happened. We've now come down, and the dollar is now trading lower than where it was prior. Now, you might say, well, why was the dollar popping on hotter numbers? The answer is very simple. Because, again, the hotter the inflation numbers, the thought process is the Federal Reserve will have to raise interest rates more, and that strengthens the dollar. But what we're clearly seeing here is that at least initially, the dollar has actually come down after basically a pop in the CPI or in the hotter than expected CPI numbers. We saw the dollar pop and then drop. Now, again, why is this happening? Well, in my personal opinion, I think that smart money, and this is key, guys, smart money knows that the economy is going to start to weaken very quickly. We know mortgage applications, 30-year lows. No one's buying a house anymore unless they have cash because, again, why are you going to pay 7-8%? That's a huge mortgage payment, especially for a consumer that has $1 trillion in credit card debt and also leverage to the hilt, right? They've spent down their COVID savings. Yeah, they still have jobs, but again, think about all the inflation we've seen. So you have a job, maybe you got a raise, a lot of people did, but it's all been eaten up because of inflation. And then you talk about home prices up here, mortgage payments even higher, and it makes it honestly tricky. Then you come around and you start looking at some of these other things. So think about all the jobs that the mortgage industry kind of deals with, and all of those are now dead in the water.
In August, U.S. inflation continued to rise for the second consecutive month, primarily due to surging gasoline prices. The Consumer Price Index increased by 3.7% compared to the previous year, slightly exceeding expectations. Core inflation, excluding volatile food and energy components, slowed to 4.3%, its slowest pace since September 2021. The spike in gasoline prices, which jumped by 10.6% in August, was a major contributor to the CPI's acceleration. Rising shelter costs also played a role. President Biden acknowledged the strain on family budgets caused by higher gasoline prices and emphasized his commitment to reducing energy costs through clean energy investments. Global oil prices have risen due to production cuts and increased demand, impacting gasoline prices in the U.S. Although volatile energy prices can influence consumer sentiment, economists anticipate overall inflation to continue slowing in the coming months. Share your thoughts on the CPI data in the comments below. For more daily dose crypto news, check out these 2 awesome videos on your screen. Click now and we will see you on the next video.